Goverdhan Gajjala, the 2023 U.S. Investing Championship winner, with a staggering 805% return. When people hear a number like that, they immediately assume he must have a secret algorithm, an institutional-grade system, or some proprietary indicator no one else has ever seen. But the truth? His method is so simple, so minimalistic, that most traders would overlook it. And in today's video, we're going to break down two things. 1. His journey from years of losses to becoming a super trader. And 2. The 3 trading setups he used to achieve exceptional returns. By the end of this video, you will understand the mindset and mechanics behind a true trading champion. Part 1. From losing to super trader. Let's start with his background, because it's nothing like the stereotype of a market prodigy. Goverdhan Gajjala didn't come from finance. He wasn't an economics major, a Wall Street analyst, or someone groomed inside the industry. He was a software consultant in Dallas, learning the market the same way many retail traders do, nights, weekends, and through painful trial and error. In the beginning, he approached the market as a swing trader, using the CAN-SLIM framework and holding positions for days, weeks, even months, but the strategy never truly fit his temperament. The slow pace, the overnight risk, and the emotional swings that came with it led to years of inconsistent performance. He struggled for years, losing money over and over.
Everything shifted when he enrolled in an online program taught by Mark Minervini, a U.S. Investing Championship winner and one of the most respected momentum traders in the world. From Minervini, he learned 3 foundational principles: control your emotions, follow rules, not impulses, build a process you can repeat. But here's the key. Gajjala didn't copy Minervini's exact style. He recognized that his own personality thrived on faster feedback loops, so he adapted the concepts, shortened the time frames, and evolved from a swing trader into a day trader. No more holding positions overnight. No more waiting days for confirmation. He executed faster, managed risk tighter, and discovered he could finally trade with clarity. That shift, aligning method with personality, is what unlocked consistency. And in 2023, he competed in the U.S. Investing Championship and posted a return of approximately 805%, one of the highest performances in the history of the competition. He achieved these results not through complexity, not through secret indicators, but through 3 simple setups executed with precision and discipline. Now, let's break them down.
Setup number 1, VCP, Volatility Contraction Pattern. The first setup in Gajjala's playbook is the Volatility Contraction Pattern, a concept he learned from Mark Minervini but refined for intraday trading. Instead of looking at daily charts, Gajjala applies the same principles on fast time frames, most often the 5-minute chart. On the screen is a 5-minute chart of NVIDIA with the 9 EMA in blue and the 21 EMA in black. The setup requires one clear precondition. Price must already be trending above both EMA 9 and EMA 21. As a day trader, Gajjala relies on short-term EMAs to stay aligned with immediate momentum. After a strong leg up, profit-taking pushes price into a sideways consolidation. What defines the VCP is that volatility contracts. Each pullback becomes progressively smaller, and volume declines from left to right. That contraction tells you supply is weakening while demand remains steady, the hallmark of a potential explosive continuation. When those elements line up, you draw a resistance line across the highs of the tightening base. The entry trigger is simple. Price breaks above resistance with a surge in volume. Stop loss goes directly under the entry candle to keep risk tight. From there, Gajjala holds until price closes below the EMA 21, at which point he exits the entire position without hesitation. If you want a deeper dive into VCP, check my video, the single trading pattern that made Mark Minervini $72 million.
Setup number 2, horizontal fade or box theory breakout. The second setup Gajjala relies on may look different from the VCP, but the underlying logic is exactly the same. Strong momentum, a period of rest, and a high-quality continuation. The first requirement is simple. Price must already be trending higher and holding above the EMA 9 and EMA 21. Without a clear uptrend, there is no setup. After that initial thrust, the stock begins to move sideways. It settles into a tight horizontal range, essentially a box. This type of action is significant because it signals institutional accumulation. Only large buyers have the capacity to keep price stable after a strong run when retail traders are taking profits. When volatility compresses like this, it tells you demand is quietly absorbing supply. The entry trigger comes when price breaks out of the box on strong volume. The stop loss goes directly below the breakout candle. If price sinks back into the box, the breakout has failed and the trade loses its edge. In some cases, like the example on the screen, the stock forms a second tight base immediately after the first breakout. If price breaks again with expanding volume, Gajjala will add to the position. After adding, he pulls all stop-loss levels up beneath the newest entry candle to lock in risk. If the trade moves in his favor, he simply trails the position along the EMA 21, staying with the trend until it decisively breaks.
Setup number 3, Classic Pullback. The Classic Pullback follows the same foundation as the first two setups. The stock must already be trending higher and trading above both EMA 9 and EMA 21. After that initial push, price pulls back gently, forming a flag-like pattern or a small contraction. This brief pause resets momentum without breaking the trend. The entry is straightforward. You buy the breakout of the pullback on strong volume, with the stop-loss placed directly beneath the entry candle. From there, the management is identical to Gajjala's other setups. Hold the position until price closes below the EMA 21.
Key takeaway. If you look closely at the 3 setups Gajjala uses, you'll notice something important. They're essentially the same setup expressed in different forms. Every strong trend has rest stops, and what Gajjala does is simply trade those rest stops. Whether it's a VCP, a horizontal box, or a classic pullback, the goal is identical. Identify the pause before the next surge. Like a train stopping briefly before accelerating again, these consolidation points give traders a window to enter with clarity and controlled risk. Because his setups share the same DNA, Gajjala never faces the paralysis that comes from juggling multiple systems. His chart is clean, his criteria are consistent, and his decisions become almost instinctive. Contrast that with traders who load their screens with indicators and conflicting signals. One says buy, another says sell, and the result is hesitation, confusion, and missed opportunities. Complexity doesn't create edge, it creates noise. But here's the part you absolutely must understand. Gajjala is a day trader. He operates on 5 to 15-minute charts where price action is fast and imperfect. That means fake breakouts are unavoidable, sometimes several within the same hour. His approach works because he treats losses as routine business expenses. A setup fails, he cuts it immediately. No negotiation, no emotional attachment. If you can't execute a stop loss the moment it triggers, if 3 small losses in a row destroy your confidence, if you need every trade to feel right before you take it, then Gajjala's intraday style is not the right fit for you. His edge isn't in just the setups, it's in the discipline to respect them. If you want a more stable method, one that requires less screen time, fewer intraday decisions, but still delivers high performance, then my trading program is built for you. On the screen, you're seeing the results of my students, many of whom are now consistently profitable, have passed funding challenges, and trade with confidence and discipline. In the past, students had to pay thousands of dollars to join my live program, but today, I'm making the entire program almost completely free. You only paid $25, about 1% of what previous students invested. Not because the program is worth $25, but because $25 creates commitment. To be fully transparent, after YouTube's 30% cut and taxes, I barely receive anything from it. So why don't I just make it free? Because there's a simple truth in trading. When something is completely free, people don't take it seriously. But when there's even a small cost, they actually show up, stay consistent, and do the work. And honestly, $25 is the price of a couple Starbucks drinks, but it could save you years of trial and error and tens or even hundreds of thousands in avoidable losses. The door is open. The only question is, will you walk through it? You can join the course through the YouTube membership section or simply click the link in the description below.